Recording in progress.
Okay, hi everyone. Welcome to today's webinar. So before we get started, we're just gonna give a couple more minutes to let more people join our session, and then we can quickly get started in a couple more minutes. So in the meantime, you can grab yourselves a drink, get yourselves comfortable, and I'll see you guys in a couple more minutes. Okay. Welcome to everybody who's just joined, and for those who have been waiting for a while, thank you guys for being patient. So for today's webinar, we're going to be looking at multi-time frame analysis. So before we do that, we're going to be going through the agenda and what exactly we're going to be talking about. So as per usual, before we begin, just a risk warning as well as a disclaimer that the information in this webinar should not be considered investment advice and or investment recommendation, but instead educational material only. So the material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of this material is also strictly prohibited. Okay, so I'm Melanie, and I'll be your speaker for today. I'm from Everest Fortune Group, who are finalists for Best FX Research and Best Equity Research in 2019, 2020, and 2021. Okay, so here's our agenda for today. So firstly, we're going to be looking at which time frame is the most important. We're going to be looking at how to take a top-down approach, which is crucial for whenever we're talking about multi-time frame analysis. Next, we're going to be looking at what you should look out for on the higher time frames. And then we're going to be zooming into the lower time frames and how we're going to craft your strategy. So before we get into time frames, let's do a very quick recap on what exactly you should look out for for all of the timeframes, because this is very important when you are trying to decide which timeframe to use. So let's just do a quick recap on support and resistance, because it's closely related to when you are picking a timeframe. Okay, so let's begin. So support and resistance levels in trading, as you should know now, refer to prices at which an asset's price tends to stop falling, which would be your support, or stop rising, which would then be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, or chart patterns. Additionally, you can also look at previous highs and lows of the asset, as well as the volume data to identify potential levels of support and resistance. So this is what we'll be focusing on for today. How to identify support and resistance levels between the multiple timeframes that you're going to be looking at. So it's important to note that these levels are not absolute and can change over time. So continuous monitoring is necessary. Okay. So I've added an image here just for you guys to see how we can use swing highs and swing lows as support and resistance levels, but we'll also go through more in depth in the next few slides. So take note of how there are clear peaks and troughs in the market structure in order for them to be used as resistance and support levels. So this is the kind of clear market structure that you're looking out for between the multiple time frames. Okay, sorry about this among the slides, but it says insignificant swings. So this is an example of an insignificant swing. So insignificant swings are typically used for like to identify support and resistance, as we are talking about them, but they're also used to identify Fibonacci levels as well. So you can see over here in the GIF, these swing highs and lows are too insignificant, and they're bad to use for Fibonacci points, but they're also bad to use for significant swings, your support and resistance levels as well. So when you have this kind of market structure, then we would change between the time frames to see which time frame gives us a clearer price structure. Okay? Okay, so here's another example of an incorrect or rather insignificant swing. There aren't really any clear swing highs or swing lows, and price movement is considerably small. Okay, so here is a correct example of significant swings. There's a clear move up and down with obvious peaks and troughs and very clear market movements. So you can see from the GIF over here that this is kind of what we are looking for when we look at the different time frames. You want to find a price structure that gives you a very clear movement in price. Okay, if you have any questions throughout the webinar, feel free to let me know in the chat as well. But yeah, let's just continue. So this is an example of a significant swing. I've drawn out the peaks and the troughs to show you exactly how clear they should be. Okay, so you can use it as, you can use support and resistance levels as take profit and stop loss levels as well, but you should not use it as an entry if there is no other supporting arguments such as Fibonacci or other graphical levels to support your analysis. So using a recent swing high or low is a weak level if it's the only level. Okay, I'm so sorry about this. Let me just adjust this so that you guys can see it better. Okay, here. So as I was saying, recent swing high or lows can be used to highlight resistance and support levels, but they're not very strong to be used on their own. Okay. So sorry about this. Okay. Let's continue. So as you mentioned earlier, using a reset swing high or swing low is a weak level if it is the only level that we are considering. So instead, what we should do is to look for support and resistance areas that line up with multiple swings. So be it swing high or swing low, if at least two swing high or swing low levels line up nicely, it's a much better level to use. So we try to find areas where these might line up. So it doesn't have to be an exact level as long as it's an area that is near enough to them. Okay, so that's why, as you can see from the GIF that I've included here, it's good practice to see how far the resistance or support level can go. So it's okay to cut through small wicks since these are typically areas that we're looking for instead of specific lines or specific levels, as you can see in the GIF. Instead of just looking at the red line, we decided to highlight the entire area instead. Okay. So now let's take a look at the starting point. So now that we know how to identify significant swings and use them as support and resistance levels, what are the things that we can look out for when inputting a support and resistance level? So I'm just going to briefly go through this and then we can zoom into timeframes. This is particularly important when you are deciding between the timeframes. So firstly, when picking the starting point or pivot entry, support resistance levels, these are the rules that we typically go by. So firstly, we want to check if there's a swing high or swing low, pullback or overlap level to start from. Okay, so we've mentioned earlier what a swing high or swing low is. So for pullback or overlap level, if you were here for the support and resistance webinars, we went in depth on pullback as well as overlap levels. But if not, I'll just briefly go through them as well. So a pullback level is something like this, where price cuts through the level and we're expecting price to pull back to the level. So in this case, this line over here is considered to be a pullback support because over here price is in line with a swing high. So price has cut through the swing high and we're expecting it to reverse back down back to the swing high here. So that's a pullback. And for an overlap is when a swing high and a swing low, when they line up with each other. So that's just a brief understanding for pullback and overlap. And those are typically considered to be pretty strong levels that we want to take note of. So another thing is to go back as far as possible, as we mentioned earlier, and intersecting the wicks is preferred. So you can see the orange thumbs represent an okay intersection. It's not preferred, but it's not exactly wrong. So preferably we want to look for intersections only of the wicks. So something like the green thumb that you see over here, it's just solely cutting the wicks. Okay. Okay, let's look at a couple more examples of this. So here, the first thumb that you see over here is a red thumb, which we should stay away from. So our levels intersect too many bodies of the candlesticks at the first swing high. So that's what we should stay away from. Instead, we want to look for candles, for levels that have clean cuts of just the wicks of the candles like you see from the green thumbs over here. Okay. Okay, let's move on to the next example. So here we want to take note of the red highlighted area. We want to avoid cutting so many of these candlesticks over here, but looking at all of the multiple swing highs over here that just cut the wick of the candlestick. That's what we're looking for. Okay, you can see over here as well, since this resistance level has cut through so many multiple swing highs, it's considered to be a pretty strong resistance level. And then just to recap, what a pullback resistance looks like would be something like this. Price has recently cut through this resistance level, and you can see it coming back down. So it's reversed off of another swing high, and it's reversing back down to the same level over here. Okay, so here's an example of a clear market structure that we want to look out for between the different time frames before you decide which to analyze on. Okay, and here is an example of an unclear market structure. So you can see I've drawn out exactly the shape of the structure so you can compare between the two. Okay. Sorry. Okay. So now let's look at which time frame is the most important. So one important thing that we can do to find clearer market structures to do your analysis on, so be it graphical or Fibonacci analysis, whatever it is that you want to look out for before you actually start your analysis. So one thing you can do is to adjust the time frames so that the market structure is clearer. So we've been emphasizing on what to look out for in order to choose your support and resistance levels. So we've gone through that in the previous slides, but how exactly can we find clearer market structures? So that's when our time frames come into play. So what might look messy on a M30 chart might look very clear on a 4-hour chart. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point in time, but it could simply mean that we need to take a step back or sometimes a step forward to get a clearer view. So here's an example. Here we have an example of an unclear market structure from the 15-minute time frame. So you can see it's pretty messy, not very clear movements in price. And when we change it to the 1-hour time frame, you can see the highlighted portion, which is where the 15 minutes was. We have a much clearer price structure. Okay. So there's two criterion that you should look out for. Firstly would be a clear swing low or swing high. Secondly would be a clear trend between the starting and ending point. And then that's how you know that the time frame that you are using is preferred. Okay. So at the very basics, the clearer the swing low, the clearer the swing high. So 2 points, swing low, swing high, and the clearer the trend between these 2 points, the more accurate your analysis will be. Oops, okay. Okay, so now what exactly is multi-time frame analysis? So we've just gone through how exactly to make use of the multiple time frames, in order to choose clear price structures so that you can do your analysis on them. But what exactly is multi-time frame analysis? So it's a trading strategy that involves analyzing the market from multiple time frames, but this can help a beginner trader get a better understanding of the market and make more informed trading decisions. So the first step in this is to select the timeframes to analyze. So typically, traders will choose at least 2 timeframes, such as a short-term timeframe, which would be your 1 minute, 5 minute, 15-minute timeframes, as well as a longer term timeframe, which would be your 1 hour, 4 hour, or the daily timeframes. So each of these timeframes has a different use as well. So the short-term timeframes tend to be used to identify the most recent trends and price movements, whereas the longer-term timeframes are used to identify the overall trend and market conditions. Okay? So once the timeframes have been selected, the trader will then analyze the market from each timeframe, and then they'll look for key support and resistance levels, like we mentioned earlier, as well as some patterns. So for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. Okay, so how exactly can you use this information? So conversely, if the short-term trend is bearish and the long-term trend is bearish, then of course we have a strong downtrend. But if one is bullish and one is bearish, which sometimes happens, then that's where your analysis comes into play. And then you want to make use of your different things like indicators, your graphical analysis, your Fibonacci levels, all of that. Okay, so if the short-term trend is bullish, as we mentioned earlier, the trader may then look to buy on dips or pullbacks in the market. Conversely, if the longer-term trend is bearish, the trader may look to sell or short the market. So in essence, the multiple time frame analysis can help a beginner trader gain a better understanding of the market by looking at the bigger picture and analyzing trends and patterns from multiple time frames. That's the general essence of multi-time frame analysis. Okay, feel free to let me know if you have any questions so far. I know we've gone through quite a bit. Okay, no questions. Okay, let's go ahead and move on. So what should you look out for on the higher time frames? So firstly would be your key graphical levels, such as your horizontal levels that we previously went through, your support and resistance levels. Next would be your trend lines, trend channels, followed by some breakouts, as well as big moving averages, such as your 50, 100, 200, golden cross, and death cross, as well as your Ichimoku cloud. We'll also be looking at big Fibonacci levels, such as your retracements, extensions, and projections. And lastly, we'll be looking at price action as well. So price action is to indicate, it shows you the past, the present, as well as the future, depending on which time frame we're looking at. So momentum from the previous bar then dictates your strategy. Okay. So multiple time frame analysis is especially useful for short-term traders such as scalpers or swing traders or even day traders. So multiple time frame analysis can give you a broad view of the market and help you identify the prevailing trend. So let's do some analysis on actual charts. Let me just pull out my charts. So let's go ahead and take a look at pound dollar first. Okay, I hope my image doesn't block the charts, but feel free to let me know if it does, and then I will change it accordingly. Okay, so for multi-time frame analysis, we look at different timeframes, obviously. So we start from a top-down approach. So we'd like to start from either the weekly or the monthly. In this case, I'm going to start from a weekly time frame. And you can see from my weekly time frame, it shows me that price is headed upwards, right? It's moving in this direction. Okay. And at the same time, while going through these different time frames on the longer time frames, that's when we can also pull out your support and resistance levels. So over here, I have a very significant and pretty strong resistance level here. Okay, so you can see because there are two multiple swing highs over here, that's why I'm saying that it's a significant resistance level. Okay, there aren't really any significant support levels. So let's just go ahead and work our way down. So here we have the daily time frame. Once again, you can see price moving in an upward direction. Okay, and we can do the same thing here. Here we have a support level. And we can see price currently testing this resistance level here. Okay, this whole area. Okay, so we're just doing a very brief analysis on the higher time frames. Then we're gonna work our way down and take a look at the 4 hours and then 1 hour time frames. So we typically like to do our analysis on either the 4 hour or 1 hour time frames, and we like to stay away from either the 1 minute or 15-minute time frame because those tend to have more noise. So it's a bit more difficult to analyze on those. But depending on your style of trading, that may be different for you. And since we trade using either 4 hour, 1 hour, there is also this technique that many traders like to use called the 4 to 6 multiple. So if let's say you are trading on the 1 hour time frame, you would trade either times 4, so it will be the 4 hour time frame, and times so either times 4 or times 6. So times 6 would be 6 hours, but of course we only have the 4 hours here. So similarly, if you're trading on a 5-minute time frame, we want to go up either by 4 times or by 6 times. So in that case, we would look at a higher time frame of 30 minutes. And you don't want to go more than 30 minutes, simply because if you're trading on the 5-minute time frame, and we are analyzing, and you decide to analyze on the 1 hour time frame, it doesn't really make sense because you're zooming out way too much. Okay, I hope that made sense. That's just a pretty common multi-time frame analysis strategy that traders like to use. So I thought I'd mention it as well. Okay, so here we have the 4 hour time frame. So we're gonna decide either between the 4 hour time frame or the 1 hour time frame. But over here, you can see that I have the support and resistance levels from earlier, from the higher time frames. You can see, since I've highlighted this area, price has tested this area many times. And it's significant even on our lower time frame. So that makes this this resistance area even more significant. Okay. Okay, let's take a look at our 1 hour time frame now. So this is our 1 hour and this is our 4 hour time frame. Okay, price structure on both of these charts are pretty clear. I think I'd go with my 4 hour instead, just because there are bigger price movements compared to the 1 hour chart. Okay, so let's go ahead and analyze on our 4 hour chart. Just a really quick analysis. Okay. So I'm trying to see if we can have any graphical analysis, so such as trend lines or trend channels. Let's see if we have a trend line here. Okay, we do. So for valid trend line, remember that we need 4 touches. Or rather at least 3 touches, but in this case we have 4. Okay. Okay. So here I've already marked out a resistance level that we can take note of. And as I mentioned earlier, since this is also relevant on our smaller time frames, that's how you can tell that this is a pretty significant level. So I'm going to label this as my first resistance. Okay, and here's my second resistance. But you can see my second resistance is not as significant as my first resistance. Look at the number of times that price has tested this resistance area. Okay, so earlier we mentioned that this is what you should avoid cutting so many bodies of candlesticks. So I'm going to go ahead and get rid of that. Okay, and I have a support level over here. Okay. So this is the support level that I pointed out earlier from the higher time frames. But after zooming in to the lower time frames, this current support level is way too far from where price currently is. So I'm just going to get rid of that. Okay. Okay, so now that we have done our graphical analysis, such as trend lines as well as support and resistance levels, now we can get into your Fibonacci levels. So here, so for Fibonacci projection, which is what I have over here, we use these 3 levels, 61.8, 78.6, and 100%. Okay, so here my 100% is actually in line with the swing high. So I'm actually going to move my second resistance down to the 100% instead. Oh, okay. Here. Okay, so earlier on, we do graphical analysis just to get a rough idea of where the swing highs and lows and potential resistance levels are. But once you pull out your Fibonacci levels, you can feel free to rearrange your first resistance and second resistance levels. So I can also tell that my 78.6 Fibonacci projection lies nicely in line with my first resistance. So I'm just going to keep those two. Okay, I can see my first support over here. I have another first support over here with two swing lows. Let's see if I can pull it back more. Okay. Okay, yeah. So here instead is going to be my first support, and here will be my second support. Okay. Okay, so now that we've done that, let's pull out your Fibonacci levels. Oh, sorry, I meant let's pull out the Ichimoku cloud indicators. So you can see price moving above the Ichimoku cloud, giving us a bullish signal, which lies in line with our bullish bias. And you can see really closely that MACD is also giving us a bullish signal. Let's take a look at RSI. Okay, RSI isn't really telling us much, so I'm going to get rid of that. And yeah, so here it is. Sometimes you can compare between the indicators between the different time frames as well. So here we're on 4 hours and price is moving above the Ichimoku cloud. If we take a look at daily, you can see it's way above the Ichimoku cloud. So it gives us a bullish bias as well. So it's weekly. But if we zoom in, we can see that it's only just breaking out of the Ichimoku cloud. So since we know, because we've analyzed the previous higher time frames, it shows us that price is moving above the Ichimoku cloud, giving us a bullish bias on the higher time frames. So even though on our shorter time frames, price is only just breaking out of our Ichimoku cloud, we know that this is a bullish signal. Okay. Okay. Let's go through one more chart. Let's take a look at a commodity instead. Let's look at WTI and compare between the time frames. So here we have WTI on a weekly time frame. Okay, you can see price kind of trending over here. There isn't really a clear market structure, but you can see, however, that we have a trend channel. Price is moving within this trend channel on our weekly time frame. So let's take a look at the daily. And over here on the daily, you can see price continuing to move within a descending trend channel. Okay, so what does this mean? It just gives us a very strong bearish bias. Okay, so we also have this support level over here. and this resistance level here. Okay, let's get into the 4 hours and 1 hour time frames. So here we have the 4 hour time frame. And let's zoom in and look at 1 hour time frame. Okay, this is what we mean by a unclear price market structure. As we mentioned earlier, you can see the price movements are pretty small, and there isn't really very clear market structure. Whereas if you take a look at our 4 hours, this is a lot better. Okay, so now let's get into analyzing this together. You see, earlier on in the higher time frames, we pointed out a descending trend channel, but now on our 4 hour time frame, we don't have that trend channel anymore. But at the back of our heads, we know that price is moving within a descending trend channel on the higher time frames. So that's useful in telling us that price might continue to move within this in a downward trend. Okay. So now let's go ahead and plot our support and resistance levels. So here I have a overlap resistance. Okay. I can see that price is also currently at this level in line with this swing high. So I'm wondering, is price going to break out of this support level, or is it going to reverse off of it? Okay. So once again, earlier this support level is from the higher time frames, but it's way too far from where price currently is, so I'm going to get rid of that. And this from the earlier time frames will be my second resistance. Okay, now that we have that, let's get into the Fibonacci levels. Here I'm plotting a Fibonacci retracement, and let me show you guys the levels that we like to use for retracement. Would be these 5 levels: 23.6, 38.2, 50, 61.8, and 78.6. Okay, so now we can see which levels line up nicely. I would say my 23.6 as well as the 38.2. Wait, let me just take a look. Okay, so even though the 23.6 lines up with our first resistance, price has already cut through this first resistance. So the 23.6 is no longer valid. So if you've been with us for the Fibonacci webinars, we would have gone through this, but just to recap and let you guys know that this level is invalid. However, our 38.2 level is still valid because price hasn't cut through this first support level yet. So we can keep that. And my 61.8 is in line with the second support as well, so we can keep that as well. So I'm just going to keep the 38 and 61. Okay. Okay, let's see if we have some more Fibonacci levels. Not really. Okay. So now let's pull out our indicators. We have Ichimoku, MACD, and RSI. So price is moving below our Ichimoku cloud, giving us a bearish bias. Let's take a look at our higher time frames to see if it gives us the same signal. Here you see price moving above the Ichimoku cloud, giving us a bullish signal. On our weekly, price is moving below, daily above, 4 hours below, and 1 hour below. Let's check 30 minutes as well. Price is moving below. Okay, so since most of the indicators line up with our bias, our bearish bias, we can go ahead and assume that this is a bearish bias. Okay? However, on our MACD, price is giving us a bullish signal. So once again, let's check it on the other time frames. Daily is giving us a bearish signal. Weekly is giving us a bullish signal. 30 minutes bearish and 1 hour bullish. So 1 hour and 4 hours give us a bullish signal. So I'm going to get rid of that because it doesn't line up with our bearish bias. Okay, so since we have one indicator that supports our bias and one that does not, let's pull up another indicator to see if it supports our bias. And here I can see that price is moving within this descending trend line, further supporting our bearish bias. Okay. Okay, let's take a look at one more chart together and just compare the time frames. Okay, let's take a look at gold. Once again, we're starting from a top-down approach. So starting from a higher time frame. Here you can see this very strong resistance level with 3 multiple swing highs. Okay, this is on a weekly. Okay, this is not a trend channel. So, okay, for both of these, we can see that price is moving upwards, right? And we can see that price recently reversed off of this resistance level for all of the time frames. Okay, so here's something I want to point out. Earlier, we saw on our weekly and daily time frames that this level is a pretty significant level since it cuts through 3 significant swing highs. So this is a resistance. Okay, but if we zoom in on the lower time frames, you can see how this level cuts through the bodies of the candlesticks, which, as I mentioned earlier, is not preferred. Right? You can see again, it cuts through the bodies of the candlesticks. So we can't use this as a resistance level anymore. Instead, we'll have to adjust it so that it doesn't cut any bodies of candlesticks. Okay? Okay. Here we have price moving within this ascending trend channel on our 4-hour chart. Okay, between our 1 hour and 4 hour, let's see which has a clearer price structure. Okay, they're both pretty clear. So let's analyze on our 4-hour chart. So we've already plotted out our resistance level. So here's my support level. Okay, so now let's pull out some Fibonacci levels. Okay, here I have another resistance level that we can take note of. Okay, now let's pull out some Ichimoku, MACD, and RSI. You can see on our price chart, price is moving below the Ichimoku cloud, but it does look like it's going to break through. So let's take a look at the higher time frames. This is a bullish signal as well. So there is a probability of 1 hour is also giving us a bullish signal. So there is a high chance that price is going to break into this Ichimoku cloud and give us a bullish signal, but just not yet. But how do we know this? Is by looking and comparing between the different time frames. Here, MACD is giving us a bullish signal, so that's okay. Okay, RSI isn't really telling us anything again. Okay, so yes, that's about it for today's webinar. Let me know if you guys have any questions. Just pop them into the chat. I'll be happy to answer them. But that's about all I have to say for multi-time frame analysis. And yeah, I hope you guys found this helpful. And I will see you guys next week. Bye. Have a great rest of your week. Thank you.